I want to build on something Ratin Roy said and put that to Neelkant Mishra, that if 1.6% of the economy's growth rate gets chopped off because of inadequate government spending, Ratin Roy makes the point that that reveals something structurally wrong with the way the Indian economy is growing. He also questions the quality of jobs being created and the quality of growth. So let's spend a moment on that, Neelkant Mishra, because the fact that we've been talking about a capacity expansion cycle kicking in for a long time. I was reading your economic outlook. You seem to suggest that in some sectors it's already started. You want to build on that and explain to our viewers why you think that this wait for an expansion cycle to begin could finally be over in your view.
Yeah, so see, the first half of the year, I think Ratan is absolutely right that any economy shouldn't be so dependent on the vicissitudes or the pattern of government spending. But, government spending tends to be quite stable. In the first half of the fiscal year, as I said, the 10-year median is 62% of the fiscal deficit is incurred. 29% is like a 25-year low. So it is very, very, very rare for a government to miss or be so far behind in incurring a fiscal deficit. And if you have that level of slippage, 1.6 percentage points of GDP squeezed into 6 months, I think that is like 3% annualized. And that's a remarkable pace of unintended fiscal consolidation, which the economy will see that. So I think we have to keep that in mind. On the quality of the growth, and before that, let me answer the question that you put in towards the end, which is why I think that the investment cycle is recovering. From 2012 to 2021, where the investment to GDP ratio declined from 34% to 27%, 7% points of decline. Most people think this was because private sector capex didn't happen. Private sector capex did slow down, but 5% points of that 7% points was because of a slowdown in the real estate sector. So it was household investment in dwellings, which was the major cause of the slowdown. So the real estate cycle in India peaked in 2012, it bottomed out in 2021, and since then has been reviving. And it is reviving for a very simple reason, that the inventory of built houses is low, prices are now more affordable than they were 10 years back because of steadily underperforming income growth. And now there is a cycle, and this is like absolutely natural. I was presenting this to someone senior in the government. He said, okay, this is happening naturally. What can we do to accelerate it? And so that's the way to see it. The second reason why the investment cycle weakened was the power generation cycle. If you recall, there was a phase where India with 130 gigawatts of power capacity was adding 200 gigawatts of power capacity. This was in 2011-12. We didn't have the coal, we didn't have the linkages, and these power plants were being built. Obviously, the story went bad very quickly. Now, between 2016 and 23, there's been barely any capacity addition. And therefore, the industry and the economy needs more power generation capacity. If you add both of these, there is a reasonable case to be built that the investment to GDP ratio, which has rebounded to 31, would actually become 34% in the 2027-28 type of time frame. So this is the reason why I think that the investment cycle is starting to revive. There are many new areas like robotic, green hydrogen, like renewable energy, like defense production, data centers, which all of them require a significant amount of capex. On the quality of jobs being created, remember that at this stage of the cycle, and I think Ratin would know that way better than me, given how deeply and how many economies he has studied. At this stage of economic development, labor is in surplus, capital is in shortage, labor's pricing power declines, and therefore the inequality tends to widen. And therefore, at this stage of development, the fact that lower income consumption is not doing well or not doing as well as the rest of the economy is something that should be anticipated. It is a political problem, it's an economic problem that needs to be addressed, but it does not, in a way, signal that the economic growth is not happening.
Okay, let Ratin Roy now respond. And let me frame the question thus, that one, there's been a lot of criticism of the government's reduction of corporate tax rates, saying, while balance sheets have become greener, a lot of it is money going into the pockets of industrialists. It hasn't been pumped back into the economy in the form of new capacity expansion. Nilkant Mishra makes the argument that that is now finally turning, and he's highlighted several sectors where he sees the investment to GDP ratio going up. A, do you buy the fact that now, because capacity utilization is where it is and that a new cycle seems to be starting, this could change over time some of the structural concerns you raised in your first intervention?
I don't think it's going to change this year. I think Nilkant's points are very logical. But let me give you an interesting facet. I now live in South India. And in South India, the real estate inventory is at its largest in the last 5 years. South India is where all the action happens. UP and Bihar, nothing happens there. I mean, I'm not saying, the majority of the population lives there. It's a big worry. But there's no action there. These are dead weights. And southern and western India is where the growth takes place. The per capita income of UP or Bihar is less than Nepal, for God's sake. So, and that's a big structural multi-year problem we have, that the majority of our population lives in areas which have per capita incomes that are LDC levels. And in the other areas, we see growth struggling, chiefly because in these other areas, one of the major impellers of growth has been manufacturing. So if what Nilkant says happens and happens at a scale wide enough to outweigh what I'm seeing in the peninsula, and real estate demand picks up, construction demand picks up, new areas pick up in adequate measure, then I would be looking at the share of manufacturing in GDP to be moving north again, and the share of employment in agriculture to be reducing again, before I'd be satisfied that the structural problems that the economy faces are being altered. When it comes to the corporate tax rate, well, I don't want to say I told you so. I did tell you so. Enough said.
Okay. Soumyakanti Ghosh, let's spend a moment talking about whether adequate investment is now beginning to take place in the India growth story. In that economic outlook that Nilkant has put out, he makes the argument that a new, fresh expansion of capacity cycle has begun. Do you buy this? Are you seeing enough data around you to suggest the same?
Yeah. I think, Rahul, if you look at the investment data as a percentage of GDP, I think, yes, there has been a steady recovery since pandemic. And the FY24 data will be available only in February 2025, but reasonable to assume that it could cross around 33% of GDP as per the current trends. If you want to break down and ask for the investments, whether the investments are happening, yes, they're happening. If you actually look into one of the proxy for these investment requirements is the gross block data of the corporates. If you look into the last 4 years data, the total number is actually at 8 trillion. So it's happening, but the issue is that it's actually happening in new sectors which takes times to multiply. For example, it is happening in sectors like renewables, it is happening in sectors like solar, it is happening in sectors like healthcare, education is also one of the sectors. So all these sectors are new age areas, and fintech is another area. So all these areas are new areas, and here it takes time for the investment to fructify. So that is possibly the reason that why you may not have seen an investment boom. As Rothin Roy mentioned, the share of manufacturing to GDP is currently around 17 to 18%. The hope is that it crosses 20%, because at the end of the day, the manufacturing sector will be the cornerstone of the more job creation. But in my sense, I think there is a pipeline of investment proposals, which we even see in our bank, which has not materialized. And hopefully, once this geopolitical uncertainty clears off a little bit, and there is some certainty on the external front, a large part of this investment will start materialize.
Okay, the big change happening in January itself is the 47th President of the United States, Donald Trump, takes over for a second term. He's promised to increase tariffs against neighbors, against countries like China, also indicated about increasing tariffs at what he called the tariff king, India. What potential short-term impact, Nilkant Mishra, do you think India needs to look out for once Trump takes over, and what impact could that have on our growth prospects for next year?
I think the most obvious impact is going to be that the cost of capital globally goes up. There are several fronts on which he has signaled he wants to act. That's been his mandate. The first is immigration, and we're already seeing that there is a lot of debate within the Republican establishment on what they mean by controlling immigration. Is it legal? Is it illegal? With H-1Bs, is it something bigger? The second front is, of course, trade, where he has threatened tariffs on everyone. including India on the reciprocal tariffs. If that was to happen, there's a direct $7 to $8 billion impact on our exports. But most likely, these are just starting points for a negotiation, and we'll see how it shapes up. But the third front on which I think he has much more control and it's very likely to happen is the extension of the 2017 tax cuts, which by itself will mean that the outlook for fiscal deficit and the debt to GDP in the US worsens. We have already seen the 10-year bond yields in the US starting to spike. And what that means is that the cost of capital for the rest of the world goes up. And Rathin mentioned earlier on that emerging markets, equity investors are deserting India. They're deserting all of emerging markets. In fact, the knee-jerk reaction, the Pavlovian instinct for any emerging market investor, and for right and understandable reasons, is that when you're getting 5% yield on US government bonds, then why would you want to hold China, Brazil, and India, or other such emerging market currencies, which we don't really understand. They don't really understand. So the cost of capital goes up. The amount of current account deficit that we can sustain goes down. The foreign generated, foreign capital flows as a percentage of GDP, if you plot a 5-year average, which is the averages over a cycle, it is down by 1.5% points versus, say, 10 years back. And what that means is that risk capital formation in the economy then slows down. So what we are seeing today in terms of the interventions that the RBI needs to do to keep the rupee stable, I think those interventions may need to will actually perhaps worsen from here. There will be other, I think, second and third order effects if the Chinese RMB was to devalue. So if Trump on day one, 20th of January, imposes, forget about 60%, even 20% tariffs on China, the likelihood of the RMB, the USD CNY falling to 7.8 goes up. If that goes up, then should the RBI let the rupee fall similarly or let it get there in 6 months? I think those kind of bets will then start getting made. So we should expect significant increase in the macroeconomic conditions, global conditions in terms of interest rates and currency after 20th.
Rathin Roy, it's very difficult to predict what Trump will do, how much of the positioning that he's taken is to do with, just setting up a position for a negotiation, or how much trade tariff increase he actually intends to push through. What's your best sense at this moment of how whatever Trump does internationally in terms of tariffs for other countries, neighborhood, China, and potentially India, could impact what we see around us in our country?
Well, I agree with a lot of what Neelkanth said. I think it's a very sensible global analysis or prognosis of what's going to come. On tariffs, I just want to point out a very interesting point, why we shouldn't get our dhotis in a twist about Trump's tariffs. India is 2% of global exports. So actually, a government of India undershooting its fiscal plans in the way Neelkanth mentioned is going to have a far greater shock on the Indian economy than what Trump does with tariffs for us, because they're not players. We are big players in the global economy, whatever we boast about. Now, if we want to be non-big players in the future, we're not talking about. Today, we are big players. The real impact, as Neelkanth rightly says, is on the financial markets. There again, I said at the beginning that what worries me in India is that, people screw things up. What are called unforced errors, a bit like in this cricket match that just finished. You go out there and you're supposed to play a defensive game and you try and hit the ball for a 6 and you get out, you lose the game. So there is a fear, I have heard from many quarters, I don't know if it's true or not, that the RBI is now following a, if you like, Hindu nationalist policy of keeping the rupee strong because it should be strong. And that is a dangerous game to play in these circumstances when there is a great deal of volatility involved. Now, I'm not saying that I'm not one of those people who believes that the rupee should find its own level, abolish all capital controls. You can't do that in a third world country like India, where people want to take their money abroad and when the playing field is not level. But a calibrated depreciation of the rupee with clear announcements effects as to what we will do when forward guidance comes in as to what is going to happen to the US dollar, factored in perhaps with any structured announcements that come, I think more clarity on that would help both foreign investors and domestic investors understand how to cope with, I agree with Neelkanth, what is going to be a very turbulent year. There is a clear, I find, lack of clarity. It's got very bad with the RBI. With the finance ministry, it was never very good. It is now absent. With the RBI, there is a clear and pleasant lack of clarity on the logic underlying its monetary policy and exchange rate actions. And the more clarity we get in, and the more forward guidance we give on how we are going to implement a policy that we publicly state, I think the more secure we will be in the next year.
So, Amirkanti Ghosh, do you see in Trump's tariffs a potential opportunity for India if he does go out and impose, forget 60, but even 20% additional tariffs on China? Could it, in a slightly more medium to long term, create more potential for India to capitalize on the China plus one opportunity and emerge as a more significant manufacturing destination than it is at the moment?
Yeah, I think, Rahul, an interesting data is that during Trump's time, last time when Trump was the president, the rupee had depreciated by 11%, and during Biden's time, it has depreciated by 29%. So obviously, if you look into that from that perspective, even after taking into account all the hullabaloo about these tariffs, I think there is an opportunity. If you look into India's export basket in the last 3 to 4 years, that has significantly diversified. That has diversified across markets. There is now more south-south trade, and also it has started to happen in exports, which added more value. For example, engineering exports is one of them. The only point of concern basically of the exports which will be price elastic, for example, textiles, garments, which we need to take care of. But a careful look into the composition of the Indian baskets in the last 3 to 4 years, you will find that there has been a lot of value addition in terms of export share, and also there has been diversification of the export bucket outside countries of US and even Europe to the more south-south. So from that point of view, India has an opportunity, and I think that whatever China will do in terms of pushing down its yuan will have some impact on the rupee, but over a point of time, I think these will be short-term disturbances, but we have seen that over a point of time, if the economic condition remains strong, the rupee will bounce back from the lows, and that is going to act as an enabler in terms of the overall export push.